Is SentinelOne a buy or a sell? Let's get started with the model. This is a mid-cap company, 7.2 billion market cap. They're trading at $22 a share, and they have 321 million shares outstanding. This company protects your computer and data with anti-malware. They were incorporated in 2013, headquartered in Mountain View, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They finally had their first positive free cash flow year in 2024, 5 million, after 3 straight years of negatives. Probably all negative before that as well. Net income is the profit or loss on the income statement. It's revenue minus expenses. And this lags free cash flow, so it's going to be negative a little longer. They're still negative in 2024. Revenue is the sales for the company, and that looks real good. It doubles from 21 to 22, up nearly 50% into 2023, up another 24% in 2024 to their highest ever, 770 million. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 8.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $7 billion. We divide that by 321 million shares. And we get a calculated stock price of $22. They're trading at $22, so they're trading at a 3% premium. It's a sell according to the model. It seems like every stock is a sell lately. What's going on? There are 152 companies in the same industry as S, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only 26 million. They don't have any debt, which is great. One of 3 companies on this list. Toast has no debt. Checkpoint Software also has no debt. They don't pay a dividend. Most companies in this industry do not pay a dividend. Free cash flow is positive, which is a really positive feature, 5 million. They rank 39th in market cap, 7.2 billion. Their price to book is equal to the median at 4.2. Price to book is stock price over book value per share. Twilio is number 1 at 2.3. We can't look at their PE, negative earnings. Look at that price to free cash flow, 1,500. Because their free cash flow is tiny, 5 million relative to their market cap. Price to sales is 9, which is a little high, but it's not terrible. They generate 770 million of revenue, a little more than median. We can't look at their 5-year annual revenue growth rate. They have not been public that long. And they're trading at $22, which is between their 52-week low and 52-week high. If you put $10,000 into this company when they started trading, you would have lost half your money at $5,200 today, a 47% total loss. At one point, your $10,000 would have been around $3,000 or $3,500. If you bought it then, you'd be up around 70 or 80% now. To summarize, I have them trading at a 3% premium, ranking 5 out of 10. I don't know if I would buy it short term, 5 out of 10. But long term, 7 out of 10. It looks like this company is finally developing into its own. They finally have positive free cash flow, and their revenue is going up a lot each year. Ratios don't look so great, 2 out of 10. Financials look really good. Positive free cash flow for the first time, and revenue is up 276% since 2021. It's still not a lot of revenue, 770 million, but they're moving in the right direction. Let's look at their income statement. Here's the 3 months ending 10/31/2023, the 3 months ending 10/31/2024. Revenue is up a lot, from 120 million to almost 160 million. Revenue grew a good amount, from 160 million to 210 million. Let's see if they give a breakdown of the revenue. Revenue in the US, 133 million. That's 63% of their revenue. International, 78 million. That's 37%. It looks like they have revenue in many countries because no single country other than the US is 10% of their revenue. Revenue went up 28% when you compare 2023 to 2024. The increase was 46.5 million. It was mainly due to a combination of sales to new customers and sales of additional endpoints and modules to existing customers. Cost of revenue is 53 million. So their gross profit is 157 million. Gross profit is revenue minus cost of revenue. This income statement gives only percentages. Their gross profit margin is 75%, so they converted 75% of their revenue into gross profit. The other 25% is the cost of revenue. Last year, their gross margins were 73%, so it went up 2%. Below gross profit is operating expenses. R&D 70 million, sales and marketing 124 million, G&A 52 million. So total operating expenses 247 million. When you take their cost of revenue, the 53 million, and their operating expenses, that's about 300 million. How much of the $300 million is stock-based compensation? They actually show you down here. $70 million is stock-based compensation. $5.8 million of the stock-based compensation is in cost of revenue, $23 million in R&D, $19 million in sales and marketing, and $23 million in G&A. Stock-based compensation is given to employees, and payroll is in all these buckets. So a good chunk of these expenses is stock-based compensation. Since their operating expenses are higher than their gross profit, they have an operating loss of $89 million, which is worse than last year, an operating loss of $81 million. They received nearly $13 million of interest on their investments. They paid only $38 million of interest on their debt, so their net loss is $78 million. Last year was a net loss of $70 million. Here's the income statement in percentages. 33% of their revenue is R&D, 59% sales and marketing, and 25% G&A. Even if cost of revenue is zero, they would still be operating at a loss because 117% of their revenue is operating expenses. I'll show you on their regular income statement. You see operating expenses $246 million. That's more than revenue, $210 million. Let's look at their balance sheet. About $1 billion of current assets, $600 million of current liabilities. So a good current ratio. It's above 1. Cash and short-term investments about $650 million. Accounts receivables, this is how much money other companies owe them when they sell on credit, $160 million. They have $60 million of contract acquisition costs because there's a lot of expenses when they try to get a new customer, a new contract. There's marketing expenses. They probably have to pay sales commissions to the person that found the customer. I mean, the list goes on and on. So a lot of these expenses are capitalized and spread over the contract of the customer. Even if a lot of expenses are paid up front, the contract may last a year or many years. So it just looks lopsided if you pass through all the expenses in the beginning. $100 million of prepaid expenses. This is when a company makes an advance payment for a product or service they're going to receive in the future. Because some landlords require 1 year of rent up front. Say rent is $1 million a month and you pay $12 million up front. You don't want to book $12 million of expenses right away. You want to book $1 million a month. That's why you carry it in the balance sheet and then spread it onto the income statement over the year. Property and equipment is $68 million. Operating lease right of use assets, $17 million. These are assets a company leases. They don't own it, but it's carried on the balance sheet as if they own it. You'll see how much they owe in the liability section. It's a similar amount. In the liability section, operating lease liabilities, $5 million. More operating lease liabilities, $15 million. They have $460 million of long-term investments. Here are some of the long-term investments: U.S. Treasury securities, corporate notes, and U.S. agency securities. Highly liquid investments, so they could earn a little interest on their cash. They have $629 million of goodwill, so it looks like they do plenty of acquisitions. They talk about their acquisitions right here. The purchase price was $83 million. $11 million of that was intangible assets. An example is trademarks, and goodwill of $73 million. They had a post-combination expense with a value of $47 million. That included 1.5 million shares of common stock with a value of $41 million and 215,000 options with a value of $5.7 million. They talk about their acquisition of PinkSafe, where they also granted restricted stock units. An RSU is just a way for a company to compensate an employee. When you receive an RSU as an employee, there's really no value because the R stands for restricted. So I might not get those shares for another year, another 5 years. But when I get the shares, then they would have value, of course. They have $727 million of liabilities, almost exactly last year's number. Their biggest liability is deferred revenue, $400 million. This is when they receive payment for a product or service before it's delivered. So it sits on the balance sheet as a liability, and when they provide the product, they remove the liability and book the revenue onto the income statement. As you can see, they have no debt in their liability section. Assets minus liabilities equals equity, $1.6 billion of equity. They raised $3.2 billion from selling their business. They burned half that $3.2 billion. You can see right here, they lost $1.6 billion from running their business. The other $1.6 billion is sitting on their balance sheet. And a lot of it is sitting in cash and long-term investments. They have $650 million of cash and short-term investments, then another $460 million of long-term investments. So over $1 billion of cash and long-term investments. Let's look at the statement of cash flows. Even though they have a net loss of $217 million, this is for the trailing 9 months, they have positive cash flow, positive $37 million. Last year they had a cash loss of $62 million. So that's a good sign, their cash flow positive. Because most of the loss is stock-based compensation. you have to strip that out because that's a non-cash item. They also have nearly $80 million of depreciation and amortization. In their investing section, they had a cash outflow of $62 million from acquisitions. This is the cash for acquisitions. If they used equity shares to fund the acquisition, it would not show up in the investing section. Only the cash part shows up. Not much in PP&E, $1.7 million. Last year, $1.1 million. In their financing section, very little going on. $23 million from the exercise of stock options, $9 million from the employee stock purchase plan. So they had a cash inflow of $32 million in their financing section. Let's look at a stock on Simply Wall Street. Its last price, 22, 7.2 billion market cap, down 6% in the past week, down 19% in the past year. 2024 has not been good to this stock. It IPO'd around $50 in mid-2021. 4 months after IPO, it hit its all-time high, 72. And it never even got that close again. Over the next 20 months, it fell about 85% from 72 to its low of 1277 in June 2023. It went up about 150% from 13 to 30, but it never hit 30 again. It did come down to 17 in May 2024. It almost hit 29 this month. That was on December 4th. Now it's down to 22. Simply Wall Street's valuation is 28. They say the stock is 20% undervalued. 30 analysts priced this stock at 30. They say the stock is 33% undervalued. Their revenue in 2020 was under $50 million. Mainly through acquisitions, it grew quite a bit. From $50 million, it broke through $100 million in April 2021, then broke through $200 million in January 2022. It hit $500 million in mid-2023. Now it's at $770 million. They did have a little debt in 2020, $20 million, but they paid it all off in 2021. Now they're debt-free. You can see their equity went up a lot in 2021, but it's been pretty flat after that. And they do have a lot of cash on their balance sheet, $660 million of cash, which is a little less than half their equity. The CEO's salary in 2021, $317,000. Now it's $600,000. Total compensation, $16 million. Tenure as CEO, 12 years. He's been there a while. Everybody and their mother, including the CEO, are selling the stock. Look at all these sells. You only find one buy in there, this buy right here, but the rest are sells. It just keeps going on and on. About 7.5 million shares was sold by insiders in the last year. Most of it was Inside Venture, 6 million. They sold at 23 a share. 76% of the companies owned by institutions, 14% by the general public, 7% by venture capital and private equity firms, and 3% by insiders. The biggest shareholder is Vanguard, 9%, Inside Venture, 7%, BlackRock owns 6%, First Trust Advisors, 2.19%, State Street, 1.58%, the CEO, 1.5%, UBS, and to close out the list, ClearBridge Investments, 0.79%. ClearBridge is a subsidiary of Salomon Brothers. They have about $190 billion of assets under management. And their employee count went up a lot, from 450 to 2,700. And the ticker trades on the New York Stock Exchange, Deutsche Börse, and Mexican Bolsa. So if you want to get a discounted cash flow model, click on the video in the top right corner. Thanks for watching.